Hey everyone, welcome back to Corporate Dakota. RNR just filed their second quarter 2026 report, and I'm seeing some really interesting shifts in their investments and how they're handling risk. Quick note, this is not financial advice, just my take on public filings for educational purposes. While their overall income is down a bit from last year, their core business looks stronger, and they're making some smart moves with their money. Let's dive into their financial picture. For the second quarter of 2026, RNR wrote about $3 billion in gross premiums. That is a bit less than last year when they brought in over $3.4 billion. This means they are writing fewer new insurance contracts overall compared to the same time last year. When we look at net premiums written, which is after they paid for their own reinsurance, it is also down. They brought in $2.27 billion this quarter compared to $2.77 billion last year. This drop seems to be a deliberate choice to reduce risk in certain areas. Now here is where it gets interesting. Even though they wrote less business, their underwriting income stayed pretty much the same, coming in around $599 million. This is great news. It means they are being more selective and focusing on the deals that are more profitable. They are being smarter about the risks they take. Their combined ratio, which tells us how profitable their underwriting business is before considering investment income, actually improved. It went from about 75.1% last year to 72.8% this year. A lower combined ratio is better, meaning they are spending less on claims and expenses for every dollar of premium they earn. This improvement is thanks to fewer big catastrophe losses and better management of their operating costs. One of the biggest reasons for that improved ratio is how they are handling past claims. They saw a favorable development of about $257 million in their property segment from past years. This means that claims from previous years are turning out to be less costly than they initially expected. That is a nice surprise in their favor. Let's break down their property segment results from April to June 2026. Gross premiums written here went down by about $180 million. This is mainly because they bought less reinsurance, which is called ceded premiums, and also because of lower prices for catastrophe insurance. But here is the cool part: their underwriting income actually went up by about $12 million. This is because the cost of claims from past years turned out to be much lower than expected, which really helped their bottom line. Now let's look at their casualty and specialty business. Here gross premiums written dropped by nearly $247 million. They are actively reducing their exposure in areas like general casualty and professional liability because rates in those areas are a bit shaky. Plus, they decided to buy more reinsurance, which explains why their ceded premiums went up significantly. This deliberate strategy led to an underwriting loss in this segment of about $43 million. However, their combined ratio here did improve. It went from over 101% last year to about 103% this year, which is still a bit high but moving in the right direction. This improvement is thanks to lower operating costs and better management of their expenses. Moving on to fee income, which they earn from managing money for others, it was down by about $11.9 million compared to last year. This is mainly because they recaptured some management fees last year that did not happen this year. And some of their joint ventures like Da Vinci and Fontana are earning less because their underlying business is smaller. Now let's talk about their investments. This is where things get a little more mixed. For the second quarter, they had net realized and unrealized gains on investments of about $121 million. That sounds good, but it is a big drop from last year when they had gains of nearly $350 million. The main reason for this decrease is that they lost money on their fixed maturity investments like bonds. This happened because interest rates went up, which usually makes existing bonds worth less. They also lost money on commodity-related investments like gold futures because prices dropped. However, they did see gains in their equity investments this year, primarily from equity futures, which is good news. Overall, their total investment result for the quarter was about $571 million, down from $783 million last year. So, while their core underwriting business is strong, their investment side took a hit this quarter. Putting it all together, net income available to common shareholders was about $654 million this quarter. That is lower than the $826 million they made last year. On a per-share basis, diluted earnings were about $15.48, down from $17.20 last year. But here is a bright spot: their book value per common share, which is basically what each share is worth on paper, went up by 5.7% this quarter to $264.7, and if you factor in the dividends they paid out, it is even higher. This indicates that despite the lower reported net income, the company is still growing in underlying value. Looking at the first half of this year compared to last year, their gross premiums written dropped significantly by over $1.1 billion. This is linked to fewer large catastrophe events, meaning less need for those big reinsurance policies. Net premiums written also fell by about $1.2 billion. However, their underwriting income for the first half of the year was incredibly strong at $1.18 billion, a huge jump from a loss of $168 million last year. This is mainly because they had much fewer large catastrophe losses this year. Their combined ratio also improved dramatically, going from over 103% last year to about 72.9% this year. This is a massive improvement, showing they are much more profitable in their core insurance and reinsurance business when big disasters are not happening. On the investment side, for the first half of the year, they had net losses of about $300 million, a big change from last year's gains of over $682 million. Again, this is largely due to rising interest rates hurting their bond investments. So even though their underwriting is much stronger this year, the investment losses have brought down their net income available to common shareholders. It was about $938 million this year, down from $987 million last year. On the bright side, their book value per S-share plus accumulated dividends grew by 7.5% this year, showing that the company is still building value. Their fee income from managing other people's money was up by about $51 million for the first half of the year. This increase is mainly due to better performance fees, which they get when the investments they manage do well. This happened because there were fewer large loss events impacting those investments this year. The portion of income that goes to outside investors in their joint ventures, called net income attributable to redeemable non-controlling interests, went up significantly by over $400 million. This is because those joint ventures had much better underwriting results this year. Again, thanks to fewer large losses. Looking at their total investments, they've increased them slightly to about $36.2 billion. They've put more money into corporate bonds and reduced their holdings in US Treasuries and short-term investments. They also increased their investments in funds like private credit and equity funds. Their total shareholders' equity also grew by about $211 million, mainly because of strong comprehensive income. But this was partly offset by them buying back their own stock and paying dividends. Now, an interesting detail about their incentives, they've got a new long-term incentive plan for 2026. This is pretty standard stuff for a company like this, offering stock options and performance shares to key employees and directors to keep them motivated. It includes forms for restricted stock agreements and performance share agreements, which is how they tie executive rewards to company performance. When we look at their cash, it decreased by about $429 million in the first half of the year, ending at $1.3 billion. This reduction is mainly because they repurchased a lot of their own stock, about $702 million worth, and also because they made significant payouts to outside investors in their joint ventures. Overall, RNR's core underwriting business is performing very well, especially in the absence of major catastrophe events. They are being selective with the risks they take, which is boosting their profitability there. The investment side is a bit of a drag right now due to rising interest rates, which is hurting bond values. However, they are still growing their overall shareholder equity, and their fee income from managing third-party capital is strong. They're also actively buying back shares, which can be a positive sign if they believe their stock is undervalued. The big story here is that RNR is managing its risk smartly in the underwriting side, which is leading to better combined ratios even with less premium growth. The challenge remains managing their investment portfolio in this interest rate environment, but their strong fee income and growing shareholder equity provide a good cushion. The risk I am watching is how sustained these higher interest rates will be and their full impact on the investment portfolio over the next year. What I am actually looking for is continued discipline in underwriting and the stability of those fee income streams. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this valuable, please like, comment, subscribe, and check out the Discord.